Welcome to the Legacy Leaders Podcast. Are you doing the best for your client to help them create their legacy? Are you creating a plan that goes far beyond finances to help people ensure that it becomes the driving force behind all decisions? On this podcast, hosts Katie Beth Hand and Stan Miller will help you with growing your practice and your clients' peace of mind. Together, they bring the best and brightest minds to share with you how to help your clients develop their best legacy. And now, here are your hosts, Katie Beth and Stan.
Welcome back to the Legacy Leaders Podcast with your host, Katie Beth Hand. My guest today is a founder, CEO, and an insurance expert. Her name is Wallis Tsai, and I'm so excited to have her with me today to share all of her wisdom. Thank you so much for taking the time to jump on with me today.
Thanks for having me.
So there are some women, a growing number of women in this industry, but tell us a little about your background and really what piqued your interest in becoming an insurance expert.
Yeah, so I started my finance career at Goldman Sachs. I was an investment banker in the financial institutions group, and that basically meant that I spent countless hours in Excel spreadsheets modeling out the inner workings of the finances of insurance companies and banks and asset managers and the like. And through that experience, I developed a really deep understanding of how these companies work, how the products are designed. And I was struck by just how often friends and colleagues were getting really not great advice. And they'd often come to me because I was a financial services sector expert and say, like, oh, like I got this pitch. Can you take a look at it? Or I got this illustration. What do you think? Some of the products in the industry, when used correctly, can just do amazing good for people. But if used incorrectly, they can end up being a mistake people regret. But the good news is that question of whether or not these products are a good idea for a given person or situation, it's usually very analyzable. And it can seem confusing up front, but the good news is that you can reach a conclusion that has you can have high conviction in and actually end up making a really positive difference in people's lives by either advising, for or against some of these insurance products. After I left Goldman, I was there for a little over 10 years. I was fascinated by this question of how can we help people get better financial advice? And that was how we started AboveBoard. My co-founder is a software developer, and together we've built this tech-forward modern approach to insurance where we leverage our efficiency to take the unique approach of just being honest with people about, is insurance a good idea or not? Right? We vehemently reject the have a hammer, see a nail mentality that sometimes plagues insurance. And so I can talk more about that, but that's really what motivates us every day, giving great insurance advice.
No, that's great. And it's so interesting. I'm coming in, which our listeners know, from the estate planning side of things. And so I've seen this happen all too often when we are making estate plans and getting information on things that people have, that a lot of times our clients, whether it was just misinformation or, like you said, I don't think there are always bad motives, but a lot of times we see clients come in and they have purchased or bought into insurance products that actually don't at all fit the needs that they have. And so that can be a very frustrating thing to see because there is a lot of misinformation out there. I do feel like insurance is something, if you don't work in the financial industry, that is easy to understand. It's easy to be overwhelmed by. And if someone says, hey, this is the product you need, it sounds good at the time. So I like that you're out there really actively addressing a lot of the information that is out there and making sure that clients are really getting set up with the correct product that they need. So talk to us a little bit about the truth versus what's complete BS. Talk to us about how to spot life insurance sales pitches that actually make sense, that actually fit a client's needs.
Yeah, 100%. So the truth versus BS framework that you referenced is I think a proprietary rating system that we use. It's a mix of flowers and turd emojis, which I think it's safe to say this is an industry first that we've developed for rating different sales lines. And I did that because I feel like it's a way of visually, very succinctly capturing this idea that with a lot of these ideas for insurance, there is something really great that can be done for some people with certain goals. But then if you kind of accept the pitch that's really not appropriate for your situation, a few years later, that can feel really uncomfortable and it turns into something you regret. And so to your question about, how can you tell if it's a good idea? I think a lot of it, Well, I can share with you how we can tell on our side as professionals, and then also how your listeners, either as advisors who aren't super insurance focused or maybe consumers of insurance themselves, can assess various ideas.
Perfect. Yeah.
So, my strong belief as a practitioner is that I don't want to recommend insurance unless I can prove to myself and my team that insurance really is the best tool for the job. And part of why we're set up as an independent insurance broker is that I also know that one carrier doesn't have the best option for everything for everybody. And that comes into play not just with respect to underwriting, where carriers can have really different opinions about the health and insurability of the same person, but it also comes into play with product design. And the analogy for that is like, you might really like one car manufacturer if you're in the market for a minivan, but then like your pick of a car manufacturer would be totally different if you were like, all right, like I'm here to treat myself to a sports car.
Right.
Right.
Absolutely.
I think having access to more than one like manufacturer, aka insurance company, is really important to make sure that we're sourcing the best possible options for our clients. And so we take that independence and we also marry it with objective factual analysis of a given client's options and goals. And the options and goals touch on the financial as well as health and lifestyle aspects of that individual person, right? Because something that can make a ton of sense for a highly compensated, relatively healthy individual in a really, high tax bracket in the state of California might be a really lackluster idea for someone who, maybe chews nicotine gum and lives in Florida. And it's just like you have to be able to parse these details and quantify them appropriately. And so on our end, we always first prove to ourselves, would we enthusiastically recommend insurance as the best tool for this client's goals or not? And because we're so efficient because of our proprietary software, if the answer is like, actually, no, like you're better off, doing a treasury bond ladder for your goal, or you're better off with your taxable brokerage account or the Roth 401k you have at work, like we'll just say that, right? So that's just objective facts, right? Like I'm not spending my time on this to promote kind of empty insurance sales lines. Like you can analyze these questions and you can reach a true, trustworthy answer for each client. And then in terms of like how people who are either in the like sort of non-insurance professional role or consumers of insurance themselves can spot stuff, I would really always ask the question of like, show me the homework you did to recommend this. Like, why this product? Why not, some other type of product or carrier? And then I think a good question to ask also, and I focused on this a lot when I was in the hedge fund at Goldman Sachs investing in financial services companies, is to ask, what is my downside scenario with this policy? And if the person that you're talking to is either like unwilling or maybe, struggles to provide a clear, cogent answer to that question, I would say that's like a pretty significant warning flag, right? Because all these products, like almost everything in life, right, have pluses and minuses, and making sure that you end up with the right tool for the job is really important.
I love that. And I like that you mentioned at the beginning, you kind of start with the end in mind, really talking to people that come in, clients and prospective clients, about what are our goals, and then working backwards from there to make sure that you have the right products to really help them meet those goals. A lot of times on our side of the industry, we see those conversations not happening. The conversation happens at the beginning when maybe they're meeting with a financial advisor or an insurance agent, and it's, oh, hey, and you also need insurance. Everybody needs insurance. And so they get set up with a policy that actually doesn't really address the long-term goals. And we have to think about all of these things very long term. So I like the system that you have for really thinking through that and for being very goal focused when it comes to insurance. One of the things that I realized that you guys talk about, that we actually talk to our estate planning clients about, is a health crisis. And so for people that are listening and for providers that are listening, talk to us about the risks of how a health crisis can really wreck our clients' finances.
Yeah, it's a great question. So with any sort of financial plan, right, there's usually some place where income factors into that financial plan, right? Whether it's earned income during your working life or income that you don't have to work for that can fund the retirement that you've dreamed of, right? Like there needs to be some income. And once you get to that place where you're ready to retire, it's a different set of considerations than when you're still working. So, how about if we take the working period first?
Okay.
So, during your working life, the biggest risk is really that illness or injury prevents you from working, or at least prevents you from working full time. And this is something that I really see like people just in their 20s and 30s are often blissfully unaware, right? Because statistically, the odds that in your 20s or 30s that you personally know a peer who's had a really significant health challenge are thankfully low, right? Like incidences of a bad disease are like low for people in their 20s and 30s. But then in your 40s, it really starts to ramp up and it just keeps going. And through your 50s and 60s. And then well, many folks retire in their 60s, even 70s. But there's a period of several decades there where the chance of having a significant health crisis of some kind. So, for example, like a colon cancer diagnosis or a multiple sclerosis experience where it's more like degenerative and like not as acute as a cancer experience might be, right? Like those things can really sideline people from work. And it's important to make sure that you have disability coverage in place so that one, you can just keep navigating the rest of your life and providing for yourself and any loved ones in the way that you want to live and not let a health crisis turn into a financial crisis, right? Like none of us can completely control how our health goes, right? There are some things we can do to try to stack the odds, but ultimately, like none of us control it completely. But what you absolutely have control over is whether you allow that risk of a health crisis to become a financial crisis too. And then during working life, it's a similar idea on life insurance where, if God forbid you died before retirement, like what would happen to the future paychecks, right? Like if you're uninsured, there are none. And the beauty of life insurance is that you can replace those future paychecks even if the person earning income dies. And the other aspect there is to really think about folks who are providing care for free. Like one mistake that we sometimes see is that people might think, oh, that the non-working spouse or the spouse who makes meaningfully less doesn't need coverage on disability or life insurance. But that's usually not the best risk management approach because oftentimes that spouse who earns less or doesn't earn at all is doing other things for the family. And maybe it makes it possible for the breadwinner to go do their job at the compensation level that the financial plan is based on. And so if suddenly one parent takes like a 40% cut in pay because they had to step back from the career they were in, now that the lesser earning spouse is incapacitated, that really has impact, right? So you want to, think about really managing the risk at the family level during the working years. Then should I shift to the retirement
Yes,
phase?
that's all. I'm thinking through this both
Mhm.
as a provider and then also as a married mom with 4 kids at home, right? That's the phase, exactly what you were talking about. That's the conversation we had several years ago. My husband and I both work. He's a
Mhm.
fireman, so much more risk at his job than at
Yeah.
mine at the law firm. But he's a fireman and already had life insurance. But, I do my stuff at the law firm, but we had younger kids in preschool and then they
Mhm.
also stayed home with me sometimes. And so we added additional life insurance when our little kids were a little bit younger
Mhm.
to kind of bridge that gap in the
Mhm.
event that something happened to me and
Mhm.
suddenly dad found himself not only being the sole earner, but also we would need additional daycare and things like that. And I think
Mhm.
it's something a lot of families don't think through when they are in those younger working years, younger with kids. And I want to point out for any listeners out there, most providers already know this, but life insurance is one of those things that, the earlier you can start it, the cheaper it is and the easier
Mhm.
it is to get. And certainly a conversation to have with your clients if you're a provider, even when they are those young family people. So that
Mhm.
kind of covers the younger working years where there's a little bit less risk.
Mhm.
But you mentioned earlier that risk gets a lot more as we tend to get a little bit older. Be kind. I'll be 40 next year. So talk to us in the 40s and 50s and 60s and after we kind of hit whether it's 60s or 70s whenever those post-working years. What are our risks there and how do we mitigate those?
Yeah, yeah. So it's really great to have solid coverage in place before you get into that stage of life where more stuff can come up. And I'll just note for your listeners, especially for disability insurance, you can end up with a policy that excludes pretty meaningful portions of one's health if you wait too long, right? Because for a lot of the sort of standard checkups that you think of, whether it's a mammogram or a colonoscopy, et cetera, those typically start getting recommended in your 40s. And it's the old adage that, if you look close enough, you'll find something. And
Right.
it starts to come up more. And so you want to try and like lock in that coverage in some ways before we know too much, right?
Right.
And so getting it done younger is not just less expensive, but it also reduces the odds that you're going to be penalized for something that maybe isn't even that big a deal. Like your doctor's not worried, but it can still interfere with insurance. Now, once you get to the retirement phase of life, that's kind of a joyful moment, right? And that suddenly, like, you have all this time, you can chart your own course in a way that maybe it was a little bit tougher when you had, kids or work or other things going on. And there, the risk to health starts to be more about, or the risk from health starts to be more about how quickly you need to draw down the savings and the income that you were counting on. Because if we just take kind of a couple, right, you know, a lot of our long-term care clients fit this description, but, a lot of people come into planning for long-term care, like we all hope we're going to live the dream, right? We all
Right.
hope that we're going to be like healthy and independent. And we're going to be like the grandma that like our grandkids are like, oh yeah, no, my grandma's amazing. She like works out and
Spend our golden years traveling. Right.
yeah,
Right.
exactly,
That's the
exactly.
dream.
Totally. 100% of us like want that for the future, right? And then like, kind of accepting mortality. It's like, well, maybe when I'm 100, I'll just go to bed and like, move on to whatever comes next, but it'll be peaceful and my family will feel like I lived a great life and didn't suffer and it'll be fantastic, right? That's what we all want.
Right.
But statistically, we know that is not the future that most of us will get, right? There are like other considerations, like the fact that for those of us who are lucky enough to see age 65, more than half of us are going to need some amount of long-term care. And then especially for women, close to like 1 in 5 end up needing long-term care for over 5 years. And if you've ever, for listeners who've ever been inside of a nursing home, like my grandfather was for a while when we were moving houses, the majority of the people in there are women, right? So there are different risks you have to consider too. But that need for long-term care can really wreck somebody's retirement planning as well as somebody's legacy planning. And sometimes it's a matter of financial necessity to have long-term care, where it's like the person's situation is that if either one or two people in the couple needed long-term care, if it's a single individual, if they needed long-term care at all, it would just completely blow apart their finances and they wouldn't be able to afford it. And then for other clients, maybe the idea of self-funding is reasonable, right? The math could pencil out, but oftentimes people still choose to use a policy for some portion of their planning strategy because it's this idea of, from a financial perspective, laying off a chunk of that risk, moving it off your own personal balance sheet so that if your future involves an Alzheimer's diagnosis where the body is going for 6 years, but the mind is not, right? Just to take one kind of common example, that that you don't have to completely self-fund that yourself. And that also frees you up in your remaining portfolio to maybe take a little more sensible risk, right? To go for things that are a little bit higher return, but might have some volatility because you already have this separate pocket that's addressing the long-term care potential need. And it's just one other thing I would share on the long-term care front is that there's also an element of family dynamics that I think it's important to consider. I'd imagine you see this in the law practice pretty often, where it's not always a completely rational pencil out the math decision. Sometimes adult children need to make decisions together. And in some families, that's real easy, but in a lot of families, it's not, right? And the idea that, like, mom or dad made sure that there was a prepaid ticket is a much easier instruction for the adult children or child to follow than like, oh geez, like mom needs to go to a home, like she fell, this is really dangerous, she can't be on her own anymore. Like, what are we going to sell? Like, what are we going to do? Like, let's get together and decide how much to spend. It's like It's a lot easier if a plan is laid in advance on usually it's the adult children stepping in.
Yes, and we do. I'm so glad you brought that up, Wallace, because we do see that a lot on the
Mhm.
estate planning side. That's one of those things we talk to our clients about when they come in is having those conversations. And we do talk to them about the importance of planning for long-term care. I think the statistic right now is that over 70% of Americans are going to spend at least some time in a nursing home. And so making sure that clients are really aware of that risk, and it's not a scare tastic. We're not out there as attorneys selling, insurance products,
Yeah.
but it is something that can really drastically affect a family. And we
Mhm.
try to do everything we can on the estate planning side to avoid family conflict. And this is one of those things. Planning for
Right.
long-term care is something very, very stressful. So anytime the parents have laid out a plan and
Mhm.
funded that, especially with life insurance, it takes so much stress and burden off of those younger generation family members, and so they can really focus on the care of their loved one. So that's when
100%.
I wanted to talk about long-term care today, because that is an issue that is so close to my heart. I don't
Mhm.
think it's not something people love to discuss, right?
Mhm.
Everybody wants to think they'll live the dream, like we talked about, of being healthy till they're 100 and passing in their sleep, but
Mhm.
that's just not the reality for most of us. And I'm
Mhm.
very thankful that there are some really cool products out there that can help us plan ahead for that, avoid that conflict. And the last thing you want is financial strain on top of
Mhm.
all of the grief almost that comes when your parents start getting older and you have to start
Mhm.
making some of those decisions. So I love
100%.
that is a piece of the puzzle that you have figured out.
Mhm.
So we've talked a little bit about disability and about long-term care. What other advice do you have for our listeners before we run out of time? Because I still have a couple of other questions for you also.
Sure, sure. Yeah, so I think one interesting thing to consider, which is actually kind of at the heart going back to the truth versus BS question, right? Like when are these ideas really smart and when are they just a thing you should pass on? Is the use of life insurance beyond income replacement. And there are totally valid use cases for permanent life insurance. Permanent is really just anything that's not term insurance.
Mhm.
Term is designed to be temporary, permanent is designed to be an entire life. But within permanent, there are a lot of different flavors. Permanent in some ways is like saying ice cream. And then if, maybe whole life is mint chocolate chip, universal life is strawberry, variable life is vanilla, right? You could go on, but they're really different and they work in really different ways. But if you're clear about what your goal is and what you're trying to get out of this policy, you can often find something that's a really smart match for the strategy that you're trying to pursue if the math pencils out in terms of other non-insurance things you might consider putting your money into. And so I think that the use cases for supplemental retirement planning and passing on a legacy to future generations are really interesting and definitely great things to explore. But it's also really important to go into that question of, is this an interesting opportunity for me as the client? Right? You want to go into that in an intellectually honest, facts-based way. And so that's why we have this framework where it's like, you know, the answer can be no, right? Like if your analysis always concludes that insurance is awesome, I would suggest that is not really analysis. So that's why in our process, the answer depends on the inputs and it can go either way.
That's great. A
Mm.
truly honest look at what
Mhm.
clients are really needing. Okay, one last question before we run out of time. This might be one of the harder ones I've asked you, actually. So, through all of the work that you're doing, you've got such a cool work history, and now out there clearing up a lot of this misinformation about insurance. Through all of this work that you've done, all of these people that you've helped, what is it you hope your legacy will be?
Oh, that's a really good question. So, I mean, I hope that I will contribute to people being well prepared to navigate some of life's toughest moments. And that, even if the thought of me or above board never crosses their mind in that moment, I will be happy knowing that people are having a better experience in this world because of what we helped them do.
That's a great answer. Keep going.
Yeah. Yeah. And I was just gonna say that I think that this idea, like above board, was started with this idea that there should be a safe harbor for where you can just figure out what makes sense, what doesn't make sense for you, and just get what you need, nothing you don't, and then move forward with confidence. And yeah, situations evolve over time, so it's important to update those plans too. But just, I want to create this safe harbor for people to navigate insurance decisions safely and effectively in a way that leaves them feeling proud of what they did, right? Like so much of the decisions we make, right? It's like you kind of like, hope it works out, right? And it's like, I think what's nice about insurance and in some ways kind of comforting is that it is very analyzable, right? If you do the analysis correctly and you're honest about what it says, the odds of making a good decision are really, really high. So it's kind of exciting in that I think there's a lot more that you can control maybe than perhaps some other big decisions one might make in life. So I just love contributing that safety and joy to the world.
Yes, I love that. And I love what you've done with AboveBoard. You've really created a process that can be trusted, right? So figuring out, allowing people to figure out what they really need, what products are really a good fit. Having a process like that you can trust is phenomenal. So thank you for all of the work that you are doing out there to really help people get connected with the things that they need and avoid all the BS that they don't.
Oh, well, thank you for the work that you do as well. I mean, the estate planning component is huge. We see that all the time as well. And it takes a team approach to really make it all work.
Yes, it's a lot of fun. I feel like our industries very much overlap, and that our goal is to really educate people and help them figure out the best course for them, long term, and make that as easy as possible is always our goal. So thank you so much. And for all of our listeners, we want to thank you for listening as well. This has been the Legacy Leaders Podcast with your host, Katie Beth Hand. And my guest today was Wallis Tsai. And to connect with Wallis, you can find her on LinkedIn, and you can also connect with her and learn more information at AboveBoardFinancial.com. We are going to link both of those for you in the show notes to make it easy for you to get connected. And Wallis, thank you again. I know you are very busy, so I appreciate you taking time to join me today.
It was my pleasure. Thanks for having me.
You've been listening to the Legacy Leaders Podcast with Katie Beth Hand and Stan Miller. For more information on them and the show, please visit pinnaclelegacylaw.com. If you like what you've learned today, do share the program with your friends and subscribe wherever podcasts are found.